What's up, traders? It's Chris here. Today I'm going to be talking about using covered calls and options to generate income. I wanted to share with you a strategy, one of the main option strategies that I use to generate income. That's right, to generate income. And so when you make a trade on an FX pair or a stock, you buy a stock or you buy an FX pair, you don't get income the moment you enter that particular trade. What if I could teach you a strategy that the moment you enter the trade, you automatically get a credit into your account? That's the power of options. And that's one of the options strategies we're going to explore today, which is covered calls. Now, the covered call we're going to be talking about is in DraftKings, something I've been talking with my students that I've been very bullish on for a while. We've been accumulating a pretty large position on DraftKings, well over 1,000 shares at this point. And so we've also written some covered calls on this, some options on this to generate that second income on it and create this little extra profit potential for it here. So just to give you an idea, here's the DraftKings play. 100 stands for the traditional options contracts are 100 shares. This is the 21st of August. That's the expiry date on it, and it's August 2020, and we had written a 35 call. Now, the average price on all the shares that we own is about 28. I'm going to show you exactly where we had bought. We bought several times, probably about 6, 7, 8 times over the last 2 weeks, but our average price is about 28.03. Currently, it's at 35.12, and the trade price on here for the option 420. Woohoo! What that actually means is, for the 420, those of you that don't know options is, so options contracts, for every single contract you write, it's the equivalent to 100 shares. So what that basically means is, if I wrote this contract and sold this call for 420, I sold 420 times 100 shares, which is $420. But we wrote 10 options contracts, so that's $4,200 in income we collected by selling this particular option contract. Now here is the actual chart, which will show you exactly where I've been buying. Originally, when I was doing DraftKings, I was kind of doing it as a day trading thing. I bought at 26.32 on this day and then bought 27.09 the next day. Several days later, I decided to exit some of that position for a little bit of profit. But then what happened is that as it started to form this kind of corrective structure here, so you can kind of see the price section is impulsive, corrective, impulsive breakout, corrective, and you kind of see this support here. Once it started to kind of go sideways, I started to feel like, I think we're going to be building up for a much larger move in DraftKings here. So I started to accumulate again, 26.60, and then earnings came out, which was very positive. It actually was a surprise earnings to the upside. So then the next day I bought some more at 28.18. The next day I bought more at 29.14, which is a big breakout day here. And then it formed another corrective structure, impulsive move, and another corrective structure. And I've added some more at 30.60, 30.61. I probably should have accumulated some more shares on these dips right here, but it's already been building into a pretty large position and I didn't want to create too much exposure, but you can kind of see this nice RL here. So you can see this support here, resistance here, support. Would have been a great RL to add on to the position. Anyways, at the time that I took this screenshot just a few minutes ago, we were at 35.04. Now, what is a covered call? So a call option contract is normally a bullish strategy or a bullish view on a particular stock or FX pair. A cover call is when you actually sell the call on that particular stock and you have, at least at a minimum, the same number of shares to match that contract. So remember, for every option contract you write, for one option contract equals 100 shares, 10 option contracts is 1,000 shares. So if you already have 1,000 plus shares in a stock and you are bullish on it short-term, medium-term, or long-term, to generate a second income on that particular stock, you can start selling calls at higher strike prices. When you sell the call, you collect the premium. That was that 420 that you had seen earlier. For every option contract, that's 100 shares times 420. It's $420. For every 10 contracts, that's $4,200 in income. When we were buying our shares at 26, 27, 35 at that time period, and this is only about 2 weeks ago, that's a 34, 33% gain. We were not anticipating that the market would gain that much that fast. And that's why we wrote the 35 covered calls on that. Now, the beauty about this particular strategy is, one, that we collected the income from the premium, which if you think about it, since we accumulated the majority of our shares at 26, 27, 28, the premium we collected on that lowers our cost basis. So instead of, what it basically means, it shifts the break-even point because we got a credit for selling those calls. That basically shifts the break-even point less. So we bought ours at 27. So looking at, this is a typical options profit diagram. This is your profit and loss. And here's the price at expiration. So to the right is the price going up on the stock, to the left is the price going down. So this strike price that we wrote it as 35, we bought it about 26, 27, 28. The market would have to go to about 23, 24 for us to pass break even point. This line right here, and this is your profit, this is your break even. So the market would have to go below 24, 23 for us to start losing money on this. And with the market being at 35 right now, the chances of that are pretty slim. So now the question becomes, why would you write a call, which is actually a bearish outlook, which is not really bearish, you're collecting income in, but why would you write a call on something already bullish? Well, again, you reduce your cost basis, you lower your break-even point on it, and again, you collect that second income. Now, normally when you write covered calls, if you have 1,000 shares, you would write 10 options contract to match that. And the reason being is that if the market closes above the strike price, well, you can see this profit potential flattens out at the strike price. If the market goes 36, 37, 38, 39, we don't make any more money because we will gain money on the shares, but we'll be losing money at the call at the same time. And that's what evens out our profit potential at the strike price. But we wrote the calls for slightly less than the total number of shares we had. So if the market closes above the strike price at expiration, the person that I sold the contract to most likely is going to exercise that contract. Now, if I didn't have the shares, I would have to pay them out of pocket, the difference in the cost of that particular option. But since I have the shares, what will happen is at expiration, if they exercise it right before expiration, I have to give out the same number of shares I have for the option contract, which is 1,000 shares. Now that's no big deal because the stock gaining from 26, 27, 28 to 35 has given me capital appreciation on the stock. And on top of it, again, I've collected that 4,200 in premium. So that gives me additional income on top of the stock appreciation. And since I have slightly more shares than I have written for the option contract, if the market does start to go to 36, 37, 38, 40, 45, I will still capture a little bit of income, not much, but a little bit of income, and capture more of that upside appreciation. And that is the benefit of writing covered calls on stocks that you are bullish on, mildly bullish to medium bullish, short, medium, and long term, is that while you're going to be holding those stocks, you're going to be gaining also that second income on the option. Now, part of the reason why this is gained is that the earnings surprise came out. It was expected to be much lower than what it came out as, so that was very bullish. But then on top of it, right around the same time, it was announced that George Soros has accumulated a pretty large position on DraftKings. And if you think about it, DraftKings is the first mover to market when it comes to online betting in the US. Now, I don't know when the coronavirus lockdowns are going to end and sports are going to return, but when they do return, there's going to be online betting, and DraftKings is going to be one of the first mover benefits of that. So that's why I'm bullish on DraftKings long term. I just didn't expect the price to appreciate this fast. But again, it really doesn't matter because I have more shares than I have options contracts. So if it continues to go up 45, 50, 55, 60, I will continue to gain on that appreciation. I've collected the income from the options that contract that I wrote, and I've collected income from the appreciation of the shares over time. Now, there is some particular risks. If the share price starts to fall, then I will be losing not only on I'll be losing on my share position, but I will still have made some money on the options contract. So I'm negating some of my risk on that. And that's the benefit of options. One, you can collect an income when you sell options. Two, you can do certain strategies to either neutralize risk or lower your cost basis that you can't do if you're just trading the underlying stock or FX pair. If you just trade a Forex pair, you can't do anything other than your spot position to adjust the risk on that particular trade. Same if you buy a stock. If you're buying a stock and you're long-term bullish on it, well, there's not much you can do other than take other positions and other stocks to kind of hedge some of the risk or neutralize some of the risk, but then you're doing it in other stocks, not the underlying instrument. When you trade options, you're trading a derivative contract on the underlying, and you're doing it with pretty good leverage. Remember, one option contract is equal to 100 shares, and if you were to buy 100 shares outright in DraftKings, you're gonna have to put up more capital than if you were to write one option contract on it. So that's the benefit of options. You get the leverage, and you also get alternative strategies to profit, and that's the benefit of options. You can take certain positions and strategies that you couldn't if you're trading those underlying Forex pairs or stock shares. You know what's also a good strategy? Smashing the like button and subscribing to our channel. It helps us with the YouTube algorithm. YouTube sees that, they love it, they give love back to our channel. It's a win-win situation. Smash that like button to help us with the YouTube algorithm. We really appreciate it. And with that being said, did you enjoy this video? Did this kind of explode your head in different ways that you can make money in the markets, not just trading the underlying, but using options? It really gives you a totally different way to attack the markets, and it really puts more arrows in your quiver and really just gives you alternatives that you wouldn't normally have. That's why I've been taking a lot of option trades lately. And so if you like this video, make sure to hit that like button, subscribe to our channel, and leave us comments below the video. Did you learn something from this? Did this kind of open your mind to new opportunities? What did you learn from this? And if you'd like to see more videos about options and option strategies to generate income, let us know in the comments below. Other than that, I hope you enjoyed this video. I'll look forward to your comments and feedback, and I'll see you in the next video.